Hello everyone. In this session we will be seeing one example. Wherein the depreciation is charged to fixed assets. So we will be solving this example. So let's see this example first. Example: when the depreciation is charged to fixed asset. Let's read it. A firm purchased an asset for rupees 4,50,000 on 1st April 2014. Installation charges rupees 60,000. One more asset was purchased on 1st Jan 2015 for rupees 5 lakh. However, the asset purchased on 1st April 2014 was sold on 31st December 2016 for rupees 3,50,000. Prepare asset account and depreciation account for year ending 31st March 2015, 31st March 2016 and 31st March 2017. Considering depreciation is charged using reducing balance method at the rate of 10% per annum. And two more informations are given. One, the books of account close on 31st March every year and the firm charges depreciation to asset account. The firm charges depreciation to asset account means the provision for depreciation account is not separately maintained. It is directly charged to asset account. So this was about the accounting approach or way that the firm is following for depreciation. And the calculation of depreciation will be as per reducing balance method at the rate of 10% per annum. Now, before solving this, let's first prepare one timeline. There are so many dates here, so let's prepare one timeline. Now what we need to do is we need to prepare a depreciation account and asset account for 3 years, that is 31st March 2015, 31st March 2016 and 31st March 2017. So in this case the accounting period begins on 1st April and ends on 31st March. Okay, so the first accounting period will begin from 1st April 2014 to 31st March 2015. The second accounting period will be 31st March 2016 and third is 31st March 2017. Now let's record all the events that have happened in this 3 years. So this timeline will help you to keep a track and it will be easy to keep a track of all the dates. So a firm purchased an asset for rupees 4,50,000 on 1st April 2014. Installation charges rupees 60,000. So 4,50,000 plus 60,000, that comes to 5,10,000. So 5,10,000 is the cost of asset which was purchased on 1st April 2014. Asset 1, purchase and at 5,10,000. Next, one more asset was purchased on 1st January 2015 for 5 lakh. Now 1st January 2015, so it is before 31st March 2015. So on 1st Jan 2015, asset 2 purchased at 5 lakh. Now this asset 1 and asset 2 are in the same category. Let's say they are machineries, okay, but we need to maintain a record for each and every asset separately. Even practically also in organization, fixed assets are numbered and the record for each and every fixed asset is kept separately, and depreciation is charged accordingly to each and every fixed asset, even if it is in the same category. Okay. Now, however, the asset purchased on 1st April 2014 was sold on 31st December 2016. Okay, so 31st December 2016, it will be in the third year. 31st December 2016, asset which was purchased on 1st April 2014, so that is asset 1, sold for how much? For 3,50,000. Okay, so these are all the events. Now this is year 1, this is year 2, and this is year 3. And then for every year we need to charge a depreciation on reducing balance method, or we also call it as return down value method. That is, we charge depreciation on return down value at the end of the previous period at the rate of 10%. Now we will be preparing one asset account, one depreciation account, and then working notes to calculate the depreciation and to calculate depreciation on each asset. Then see, one of the asset is sold, so we also need to calculate what is the profit and loss on the sale of asset. So first we will be doing all the working notes, and then we will be posting entries in the asset account and depreciation account. But for the presentation purpose, you need to prepare asset account and depreciation account first, and then followed by your working notes. So this is a asset account. We have date, particulars, amount, date, particular amount. Debit side, credit side, and this is depreciation account. Now we will first prepare the working notes. Now let us prepare a working note 1, and here we will be calculating the depreciation and WDV. Asset 1, asset 2. So asset 1 was purchased on 1st April 2014. Asset 2 was purchased on 1st Jan 2015. Now, cost of asset 1 is 4,50,000 plus 60,000, that is 5,10,000. Cost of asset 2 is 5 lakhs. Now, depreciation. So less depreciation. So depreciation is on the reducing balance method at the rate of 10%. So for asset 1, the depreciation is 5,10,000. Now year ends on 31st March 2015. So this asset 1 was used for entire year. So this depreciation will be 10% on 5,10,000. So that is 51,000. And asset 2 depreciation is 5 lakh into 10%. Now this asset 2 was purchased on 1st Jan 2015. So for year 14-15 this asset was used only for 3 months. So we have to calculate depreciation proportionately for 3 months. That comes to 37,500. So once we reduce this, we get 4,59,000 and 4,62,500. This is WDV as on 31st March 2015. Now next. Now WDV as on 31st March 2015. Now less depreciation for 2015-16. So depreciation for 2015-16 is now these two assets, asset 1 and asset 2, have been used for entire year of 15-16. So the depreciation will be 10% of 4,59,000 for asset 1. So that comes to 45,900, since the depreciation needs to be charged on reducing balance method. And for this it is 46,250, that is 10% of 4,62,500. So once we reduce this, we get 4,13,100, 4,16,250. This is WDV as on 31st March 2016. Now let's look at the timeline. So in the year 2016-17, that is from 1st April 2016 to 31st March 2017, there was a sale of asset. Let's look at the timeline to find out the details. So this asset 1 was sold for 3,50,000 on 31st December 2016. So now what we need to do is, for this asset which is sold, we need to calculate depreciation till 31st Jan 2000, for this asset sold, we need to calculate depreciation for 31st December 2016, and accordingly, once we calculate depreciation, we will find out what is the WDV as on 31st December 2016. Then we compare it with the selling price of 3,50,000 and find out what is the profit or loss on the sale of the asset. So let's first calculate the depreciation and WDV on 31st December 2016 only for asset 1. So this is WDV as on 31st March 2016. Now less depreciation for 2016-17. Okay. So in that, for asset 1, depreciation up to 31st December 2016, that will be 4,13,100 into 10%. Now this asset is used for 9 months, that is from 1st April 2016 to 31st December 2016, that is 9 months. So 9 divided by 12. So the depreciation is 30,982.5. Now let us calculate what is a WDV of this asset. 4,13,100 minus 30,982.5. So WDV of the asset is 3,82,117.5. Now this WDV of asset 1 as on 31st December 2016. Okay. Now let us calculate the depreciation for asset 2 also. So depreciation for the asset 2, since the asset 2 is used for the entire year, depreciation will be for all the 12 months. So 4,16,250 is the WDV into 10 divided by 100. So that comes to 41,625. So your WDV is 3, I'll write it here, 3,74,625. Now this is WDV as on 31st March 2017. Now as on 31st March 2017, there was no asset 1. So WDV of the asset 1 is nil as on 31st March 2017. Now we have got what is the WDV as on 31st December 2016 for asset 1. Now let us calculate what is the profit and loss on the sale of the asset. We will prepare one more working note for that. Working note 2 for calculation of profit and loss on the sale of asset 1. So what is the selling price or sales proceeds that we received? It is 3,50,000. WDV as on 31st December 2016. How much is the WDV? 3,82,117.5. So if you see, WDV is greater than sales proceeds. So whatever is the difference is the loss on the sale of asset. Is 32,117.5. Now we have calculated everything. We have calculated depreciation for every year. We have calculated loss on the sale of asset. Now we will prepare a asset account and depreciation account and post the journal entries in the asset account and depreciation account. Now asset account. So what is the first event in the year first, that is 2014-15, on 1st April 2014, asset 1 purchased at 5,10,000. So the journal entry for the purchase of the asset will be asset account debit to bank account. When nothing is given, we are assuming that the payment is made through bank. So asset account debit to bank account. So let's post the entry on the debit side of the asset account. Debit side of the asset account, 1st April 2014, bank account, and amount is 5,10,000. Now the next transaction. So in the year 1, the next transaction is on 1st Jan 2015, asset 2 was purchased at 5 lakh. So let's record this purchase of asset in asset account. Entry will be again asset account debit to bank account 5 lakh. So on the debit side of the asset account to bank account 5 lakh. On 1st Jan 2015 to bank account 5 lakh. Now for year 1, there are no more events of purchase of sale of assets. So on 31st March 2015, we will calculate depreciation and record the entry for depreciation. Since the depreciation is charged to asset account, the entry will be depreciation account debit to asset account, and whatever the amount of depreciation we have calculated, we have to write it. Let's see the working note 1 to find out what is the amount of depreciation as on 31st March 2015. So for the year 2014-15, the amount of depreciation is 51,000 plus 37,500. That comes to 88,500. So let's record this entry for depreciation. So depreciation account on debit side 31st March 2015. Entry will be depreciation account debit to asset account. So to asset account, amount is 88,500. And on the credit side of the asset account, March 2015 by depreciation account, amount is 88,500. So now there are no more events for the year 14-15. Now we will close the books for the year 14-15. The total is 10,10,000. 10,10,000 and 31st March 2015 by balance carried down 10,10,000 minus 88,500, that comes to 9,21,500. Now this balance we will take it to the next year. So 1st April 2015 to balance got down 9,21,500. So this was about asset account. Now let's close the depreciation account also. Depreciation account, there is one entry on 31st March 2015. So when we close the books of account, we will transfer this to profit and loss account. So on 31st March 2015, we'll transfer this to profit and loss account. So the entry is profit and loss account debit to depreciation account. So on the credit side, by profit and loss account, 88,100. Since the depreciation is a nominal account, expense account, we transfer it to profit and loss at the end of the year. So 88,500. So there is no opening or closing balance in the depreciation account. So this was entries for 14-15. Now for the next year. In year 2, that is year 15-16, there are no events of purchase on sale or sale of assets. So as on 31st March 2016, we'll pass the entry for depreciation for the year 15-16 and we'll close the books. So let's see what is the amount of depreciation for the year 15 and 16 in working note. So depreciation for 15 and 16 is 45,900 plus 46,250. So that comes to 92,150. So let's record this in the books of accounts. So in depreciation account, on the debit side, 31st March 2016, to asset account, amount is 92,150, and on the credit side of the asset account, March 2016 by depreciation account $92,150. So now let's close the books of accounts. 9,21,500 is the total. On 31st March 2016, by balance carried down 9,21,500 minus 92,150, that comes to 8,29,350. So on 1st April 2016, to balance brought down 8,29,350. Now let's close the depreciation account also. The depreciation account, since it's an expense account, on 31st March 2016 it will be transferred to profit and loss account. So entry will be profit and loss account, debit to depreciation account, amount is 92,150. Since it's an expense account, nominal account, there is no opening and closing balance. Now let's see in the year 3. In year 3, on 31st December 2016, asset 1 which was purchased was sold for 3,50,000 on 31st December. So we need to record the sales proceeds that are received from the sale of the asset, and then we need to record the depreciation till 31st December 2016, and we also need to record what is the profit and loss on the sale of the asset as on 31st December 2016. And then on 31st March 2017 we need to record whatever is the depreciation for that asset 2 or remaining assets. In this case it is only one asset that is remaining on 31st March 2017, that is asset 2. Now asset is sold for rupees 3,50,000. So let's first record this entry. Now whenever the asset is sold, so what will be the entry? Asset goes out. So entry will be bank account debit. Since nothing is given, we assume that we have received a payment by bank in bank account. So bank account debit to asset account 3,50,000. So on the credit side of the asset account, we'll record this entry first. So on the credit side of the asset account, 31st December 2016, by bank account, how much is received? 3,50,000. Now we will record what is the depreciation for this asset on 31st December 2016. So entry will be depreciation account debit to asset account, and let's see the amount of the depreciation. So the depreciation is 30,982.5. Let's record this. So in the asset account credit side, by depreciation account, how much is the amount? 30,982.5. And on the depreciation account debit side, 31st December 2016 to asset account, 30,982.5. Now We have already calculated loss on sale of asset. Now we need to record this loss on sale of asset in asset account. What will be the entry for the loss of sale of asset? The entry will be loss on sale of asset account debit to asset account. Since it's a loss and expense, we have to debit loss on sale of asset account debit to asset account. So this is the amount of loss, 32,117.5. So let's record this entry in the asset account. In the asset account on the credit side, 31st December 2016 by loss on sale of asset account, and the amount is 32,117.5. This is a loss on sale. The second effect of this will be in your loss on sale of asset account. On the debit side, we have to write to asset account, 32,117.5. And since it's a nominal account, it's an expense at the year end, that is as on 31st March 2017, the balance 32,117.5 will be transferred to your profit and loss account. So this loss on sale of asset will appear in your profit and loss account at the end of the year. Now let's see the next transactions during the year. Now we need to calculate what is the depreciation for remaining asset as on 31st March 2017. So as on 31st March 2017, only asset 2 is remaining. So whatever is the amount of depreciation for that asset for the year 16-17, we need to record the entry for that. Let's see what is the amount of depreciation. So the amount of depreciation for asset 2 is 41,625. So let's record this in your asset account and depreciation account. So depreciation account debit side, 31st March 2017 to asset account 41,625, and asset account credit side, 31st March 2017 by depreciation account, and amount is 41,625. Now since there are no more transactions during the year, we'll close the books of accounts. Total is 8,29,350. And 31st March 2017 by balance carried down. Let's calculate what is the balance carried down here. It is 3,74,625. 1st April 2017 to balance brought down 3,74,625. Now see this 3,74,625 is a balance brought down. So ideally there is only asset 2 as on 1st April 2017 in the books. So this 3,74,625 should be equal to whatever is the WDV of your asset 2 as on 31st March 2017 that we have calculated in the working note. Let's cross verify it. See, WDV as on 31st March 2017, 3,74,625, and for asset 1 it's nil. So this is one of the way to cross check and verify whether all the entries for the profit and loss on the sale and depreciation on the sale of asset are posted correctly. Now let us close this depreciation account also. Total 72,607.5. And on 31st March 2017, by profit and loss account 72,607.5. So all this total depreciation, including the depreciation on assets sold, is transferred to profit and loss account at the end of the year, that is 31st March 2017. So this was about the example wherein we have seen how to calculate the depreciation and accounting entries for the depreciation, for the purchase of asset, sale of asset, profit and loss on the sale of asset. So it is always better to prepare a timeline. Okay, this timeline with the events will be helpful as a guideline, since there will be many dates and the year end will be different for different entities. So it is better to prepare a timeline and accordingly record all the events one by one. So it is easy to keep a track also. So this was about the depreciation as per reducing balance method.